With everything taking a beating, what's the pre-retirement investor to do? A closer look in this week's Fastest 4 Minutes in Finance. Hello again, I'm Scott Inman. Well, it is March Madness, and that means you never know what you're going to get and what's going to happen in the NCAA basketball tournament. There are always upsets, and you never know where or when they will happen. The market has certainly provided some of that lately. It's been nearly impossible to predict the market madness, when it will occur, what will cause it. March 15th was the 50th trading day of the year, and at the end of the day, the S&P 500 was down more than 10% year to date. That's among the worst starts to a year ever. In fact, Ryan Dietrich from LPL Financial tells us only 3 years were down more than 12% on day 50, which is where the S&P was to start day 50 this year. And it's not just stocks that are being upset like a 16 seed beating a 1. The classic 60-40 portfolio is down more than 10% this year too. That puts it on pace for the worst performance since the 2008 financial crisis. That means if you are entering retirement and have your portfolio allocated to 60% equities and 40% fixed income, it is not as conservative as it once and still is considered to be. It also means you could have a real problem trying to withdraw from your portfolio and make it last for the rest of your life. The problem for fixed income right now is high inflation is pressuring interest rates higher. That drives bond yields higher, but when yields go up, bond prices go down, which negatively impacts the bond's total return. Isabella Goldenberg, the U.S. head of portfolio strategy for Goldman Sachs Asset Management, says, quote, "The very good returns of the past decade mean that it's important for investors to establish more realistic return expectations." Andrew Patterson, the senior economist at Vanguard Group, Inc., says markets are verging on a period of low gains for the 60-40 portfolio. He estimated that annual returns over the next 10 years will be south of 5%. So what is an investor to do, particularly entering retirement? Well, we would recommend 3 things. Make sure you have a plan. Simply allocating to a 60-40 portfolio and randomly withdrawing from it is not a plan. A specific, definitive retirement income plan should let you know what type of investments you will sell to generate income and how much you can expect to receive on a monthly basis. Number 2, realize that stocks and bonds are not the only asset classes available to you. Alternatives like commodities or real estate can offer diversification and potentially non-correlation in the times when stocks and bonds are moving in the same direction. Number 3, consider your need for guaranteed lifetime income. Using some of your assets to create an income stream that you cannot outlive and remains the same no matter the market conditions can add stability to your retirement. Just like no one can predict a perfect NCAA tournament bracket, no one can create a perfect investment strategy. But a strategy that expects the unpredictable is better prepared when the unpredictable occurs. Thanks for watching.